Hey everyone, welcome to this explainer on management accounting. Today we're diving into the absolute lifeblood of any successful business, understanding your expenses. We're going to unpack cost classification and behavior. Look, if you want to know how a business truly makes money, you literally have to know exactly where its money is going. So today we're mapping out these concepts so you can stop guessing and start analyzing like a true management accountant. Okay, let's dive into this. Imagine you're starting a small trading business. You go out to the market and buy a mobile phone for 25,000 rupees. What should your selling price be? If you instantly thought, well, anything over 25,000 is profit, hold on a second. What about the 200 rupees you spent on a cab just to get to the market? Or, the lunch you bought while you were there? If you don't account for those hidden costs, your perfectly calculated profit margin might actually turn out to be a loss. Setting a proper selling price means you absolutely must know the whole shebang, every single one of your costs. And that brings us directly to the why. Why do we even bother classifying costs in the first place? Well, as we just saw, the first reason is figuring out an appropriate selling price. But it goes way beyond that. Imagine you're handed a budget of 1 lakh for the month. To plan effectively, you need to know exactly how much goes to materials, how much to labor, and how much is just overhead. Classification also helps you control costs. Like, if the market price for your product suddenly tanks, you need to know exactly where you can cut back to keep your head above water. Finally, it's totally crucial for decision-making. If product A gives you a $20,000 profit, but product B is bleeding $30,000, you need accurate data to make the tough call and drop product B. Because, let's be real, operating in the dark isn't just bad practice, it's exactly how businesses fail.
All right, Section 1, Cost by Function. We're looking at production versus non-production.
To get out of the dark, we have to start categorizing. Think of your business as having a very strict boundary line, kind of like the factory doors. Inside those doors, on one side, we have our production costs. These are the expenses required to physically make the product. We're talking direct materials, wages for the factory workers, and factory overheads, like machine maintenance. But outside of those doors, we have non-production costs. These are the things happening away from the factory floor, like a salesman's salary, the electricity for the admin office, or the distribution trucks. Drawing this clear line is step 1 in bringing some order to financial chaos.
Now, right within that production side, there's a very special metric we look at. When you take all your direct, highly traceable production expenses, so your direct materials, direct labor, and any other direct expenses, they combine to form what management accountants call the prime cost. Think of this as the holy grail number. It is the absolute baseline, the core cost of creating a single unit of your product before any of that messy general overhead gets involved.
Moving right along to Section 2, Cost Behavior, specifically the impact of activity levels. Our first behavioral category is the fixed cost, and this brilliantly illustrates how some expenses act. A fixed cost is exactly what it sounds like. It's an expense that remains the same in total, regardless of your activity level. Think of your factory rent. The landlord really doesn't care if you run the machines day and night to churn out 10,000 units, or if you just lock the doors and go on a month-long vacation. The rent is the rent, and you have to pay it. Let's look at the progression here. We start at 0 units produced, bump it up to 500, and finally push it to 1,000 units. But look at the total factory rent. It is a perfectly flat line. 10,000 rupees, 10,000 rupees, 10,000 rupees. The total fixed cost simply refuses to budge, even as we completely ramp up our production. But here is the absolute aha moment of management accounting. What happens to that fixed cost on a per unit basis? If you make just 1 unit, that entire 10,000 rupee rent is absorbed by that one single item. Yikes, right? But as you scale up and make 1,000 units, you divide that 10,000 rupee total rent by 1,000. Suddenly, the fixed cost burden drops to just 10 rupees per unit. This is the secret sauce behind economies of scale. As your production increases, fixed costs per unit decrease, which directly widens your profit margins. Now, on the exact opposite end of the spectrum, we have the variable cost. Unlike our stubborn factory rent, a variable cost is incredibly flexible. It changes directly and proportionately with your activity levels. If you're manufacturing plastic chairs, you need a very specific amount of raw plastic for each chair. If you make more chairs, you need to buy more plastic. It's that simple. The cost moves in lockstep with your production. So the crucial point is really clear when we map it out. At 0 units produced, your total variable material cost is 0. You didn't make anything, so obviously you didn't buy any materials. But as you produce 100 units, your material cost hits 200 rupees. At 500 units, it climbs directly to 1,000 rupees. The total cost climbs exactly in step with your production volume. But we have to flip our thinking again when we look at this per unit. Remember how fixed costs per unit went down as we made more? Well, variable costs are different. While the total variable cost skyrockets with volume, the cost per individual unit stays perfectly flat. If it takes 2 rupees of plastic to make one item, it will take exactly 2 rupees of plastic to make the 500th item. The total changes, for sure, but the per unit cost is always the same. All right, let's head into section 3, mixed and stepped costs. This is all about navigating the real world. Because let's face it, the real world is a bit messier than just purely fixed or purely variable. Enter the semi-variable cost. You can also think of this as a mixed cost. This is an expense that kind of has a split personality. It contains a rigid, fixed baseline element that you absolutely must pay, but it also has a flexible, variable element piled on top of it, completely depending on your usage. The classic example here is a traditional utility or telephone bill. Step 1 of this bill is the fixed line charge. Let's say it's 500 rupees. Even if you lock up your office doors, turn off all the lights, unplug every device, and don't make a single phone call all month long, the telecom company is still going to send you a bill for that 500 rupee baseline connection charge. Frustrating, right? Let's move to and see how this builds. Now you actually start doing business and you pick up the phone. For every call you make, the company charges you an additional 10 rupees. This is the variable component. Your activity level, which is the number of calls, is directly driving this portion of the cost up. So, to find your total mixed cost, you have to do a little bit of simple math. Let's say you make 100 calls this month. You pay your 500 rupee fixed fee, plus you pay 1,000 rupees in variable fees. That's 100 calls times 10 rupees. So your total semi-variable bill comes out to 1,500 rupees. Recognizing this split is absolutely vital. If you try to treat a mixed cost as purely fixed or purely variable, your future budgeting is going to be completely out of whack. Now, what's really interesting about this slide is our final concept, stepped fixed costs. We said earlier that fixed costs stay flat regardless of activity. And, that's true, up to a point. That point is your physical capacity limit. If your current factory can only hold enough equipment to produce 5,000 units, your rent is flat at one lock. But what happens when demand surges and you suddenly need to make 6,000 units? You hit the ceiling. You literally have to rent a second facility. Instantly, your fixed cost jumps up a step to 2 lakh rupees, creating a brand new higher baseline for your next stage of growth. We've covered a ton of ground today, moving from the function of production versus non-production right into the behaviors of fixed, variable, and mixed costs. But look, knowledge is only useful if it's applied. So I'm going to leave you with a provocative thought to ponder. Take a close look at your own entrepreneurial ventures, or hey, even just your household budget. Are you truly classifying your costs properly? Because if you aren't tracking exactly how your expenses behave, you're almost certainly leaving your true profit on the table. Thanks so much for joining me for this explainer, and I'll catch you in the next one.